Let's be honest, this is the craziest market that I can remember, at least since 2008 or 2009. In that market, we didn't have any idea if the economy was collapsing, what exactly was going to happen, what was going to fall next. But this market is completely wild because it's riding on what one person is tweeting or putting on Truth Social. President Trump, just after 1 p.m. Eastern time, said that he was pausing tariffs on almost every country around the world. The 10% tariff is going to stay in place. And then tariffs are going to go up on China, but most tariffs are going to be paused for 90 days. Now, that's really all we know at this point, and that has caused a massive rally in stocks. This is something that a lot of investors were really anticipating was coming, was that these tariff announcements that came out last week were just kind of a negotiating ploy. But then I think over the past few days, it's really come to the market's attention that this is a fundamental shift in the way that the Trump administration wants the US economy to run. They want more manufacturing here. They want to eliminate trade deficits. They want to increase tariff revenue, which is essentially a tax on people who are actually buying stuff. And that's thrown the market into a tailspin. That's why we saw the massive collapse in stocks late last week, and that started again early this week. But it's kind of been in limbo over the past few days. This at least gives us a little bit of clarity for the next couple of months. Now, this next step is going to be, does China come to the table? But I want to use this opportunity to explain why I invest the way that I do, why thinking long-term about investing is the way to profit in these markets. To be clear, I have not bought any stocks since last week, since before the tariff announcement, because I didn't want that to cloud my judgment. I buy stocks at the beginning of each month for the asymmetric portfolio. I continued to do that in April. I will do that again in May and in June. The only rules that I have is if the stock market, if the S&P 500 gets to bear market territory or a 20% drop from its peak, I'm going to actually increase my purchases. I'm going to buy even more because I want to be greedy when others are fearful. But let's go through the market's reaction and take a step back and compare that short-term trading with long-term investing. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with a couple of charts. This is a chart. This is Google Finance from the S&P 500. You can see that right now, the S&P 500 is up 7.83%. I'm not sure if that would be the biggest gain ever in history from a percentage perspective, but it's probably going to be close. But let's take a step back. Let's look at the year-to-date numbers. You can see this is when the tariff announcements came out. Here after the market closed on April 2nd, that caused the collapse that we've seen over the past few days. So we are not yet back to where we were on April 2nd, so just a week ago. And for the year, the market is down almost 9% even after this recovery today. So the market overall is skeptical about what's going on from a trade and tariff perspective. Let's look at a couple of other indexes because the NASDAQ has actually magnified what we're seeing with the S&P 500. You can see that the NASDAQ up 9.5% today, but if you pull back for the year, down 13.4%. And that's partially because a lot of the big tech companies, which make up a big chunk of the NASDAQ composite, they are also in the S&P 500, but they're a huge chunk of the NASDAQ composite. They have really struggled this year. Apple in particular, I'll get to them in just a second, is going to be very impacted because most of their production is in China. They can shift things around, maybe make some things come from India, but they are going to see significantly higher costs. And that's probably going to be true across a lot of tech companies. The Dow Jones Industrial Average, a little bit older, kind of more steady companies, but similar story here. Massive pop of 6.1% as I'm recording. But again, you pull back, down 6.1% for the year, and 1 year out, up just a little bit even after today's pop. Apple, the huge winner today, despite the fact that I don't think this really resolves their China problems, and this could actually make them worse if the increase in tariffs to over 100% on China are going to hold at least over the next month or two. But look at what's happened to Apple year to date, down to 23.5%, because tariffs are going to be a huge headwind for the company. On top of that, there's a lot of questions about how much the economy is going to grow. Are people going to be buying iPhones and iPads and Macs? Hasn't really been a growth market for them, that hardware business. So they've been making more money on services. That's kind of like a tax on the products that they have and the hardware that they have out there. So I think the market's starting to question, should we really be paying 30, 35 times earnings for a company that's not really growing at this point? And the growth that they do have is just increasing the revenue per customer. So that's why you see a stock like this down. But let's take all of those examples, and I'll go through them backwards, and zoom out further. Because this is what I want to highlight, is that long-term investing is where we know we have an advantage. This is what asymmetric investing is all about, is taking a decade or multi-decade view on what's going to happen with companies and with the market. As the saying goes, time in the market beats timing the market. I don't know how you would ever possibly time the market over the past 4 or 5 days, let's say 4 or 5 trading days. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. But if you pull back with Apple over the past 5 years, shares are up 187%. So you could have, in 2020, this is after the pandemic, remember, you could have bought shares and just said, you know what, I think Apple is one of the best companies in the world. You would have had a phenomenal return over that period of time. Same thing with the Dow Jones Industrial Average. 5-year return, 69%. Let's go to Max. This is going to go way back to 1985. You can see that that's up 3,068%. So the long-term trend is that being a long-term investor is going to be the way to make money. This is a table, comes from the data's from LPL and FactSet. And if you stay fully invested all the time, the annualized returns is 7.7% from the market. That was between 1990 and 2019. If you missed just the 2 best trading days of the year, so that's probably today, your return would have gone to almost zero. If you missed the 3 best trading days of the year, your returns would have been negative. And if you missed the 20 best trading days of the year, your returns would have been negative 27%. So if you can predict which days are going to be the days that stocks are going to pop 6, 7, 8%, then you should be a day trader. You should probably be a billionaire by this point. But I think these things are so unpredictable that the best way to invest is just investing long-term, just staying invested, because over time, the market is going to go up. That's exactly what we learned from history. Earnings go up, revenue goes up, especially if you're buying companies, great companies that are differentiated in the market and have some sort of earning power or ability to outgrow GDP growth. That's going to put you in a phenomenal position. So what am I doing in a market like this? In April 2025, I am doing absolutely nothing different than what I was doing in March or what I was doing in March of 2024. I am simply buying stocks once a month. Like I said, if the market does drop over 20%, I'm going to double my investment every single month, because long-term, that tells us that that's a buying opportunity. And I'm going to lean into the uncertainty of this market. We have no idea what's going to happen with tariffs. We don't know when announcements are going to come out. We don't know what those announcements are going to say. Are they going to be higher tariffs than the market expects? Are they going to be lower? Are they going to be positive for the US economy or bad? Is it going to increase trade with Europe or China or reduce it? We have no idea. And there are so many players in business and in the market, there's just no way to predict it except to buy the best companies that we can and put time on our side. Because historically, if you are a long-term investor and you're buying companies with excess growth and the ability to expand their margins, that is going to be how you beat the market. That is what asymmetric investing is all about. That's why I haven't made any trades with all of this tariff news going on. So I didn't miss the pop that happened on Wednesday. I've even seen comments here on YouTube that buying stocks now is a terrible idea because the market is going down. Well, if you sold all of your stocks on Tuesday, well, you would have missed this jump on Wednesday. So simply staying invested, doing the simplest thing, is generally the way to invest in this market. That's exactly what I'm doing. I'm going to continue buying stocks once a month, and we'll up that if we do get more of a pullback. If there is an impact on the economy or earnings from tariffs, that could impact the market in the future. But I'm not afraid of that because that's going to give me better prices for the companies that I think have long-term, multi-decade growth potential. So hopefully that's helpful in framing exactly what's going on in today's market and why you don't want to try to time the market in times like this. We don't know when good news or bad news is going to come out or what the market's reaction is going to be. So simply doing nothing is often the best response. Let me know if you have thoughts or comments in the comment section below. Thanks for watching, everybody. See you here next time.